Financial stress test. What is it? How does it affect you? How does it affect your investment and your real estate properties? Stay tuned for this episode of Prime Property TV. Good day, Toronto. Welcome to episode 10 of Prime Property TV. In this episode, we'll be talking about one of 4 financial policies that have been implemented a few weeks ago. But before we get started, I need to give you guys a little bit of background, okay? So right now, Canadians are in the most debt they've ever been, okay? And this is a crazy number that I read, but apparently us Canadians are, for every dollar we earn, we spend $1.70. That's almost double what we earn. That's nuts. When I saw it, like I said, it was crazy. But if you think about it, with real estate prices increasing, which effectively increases mortgage, that number actually makes a lot of sense. So what that did is our Minister of Finances, Bill Morneau, got a little bit worried and he made these 4 rules, okay? Now the second piece of the background that I want to talk about is mortgage insurance, okay? This is going to be affecting some of the policies and you guys need to understand this. So I'm going to try to give it to you in the layman's term. Remember, no technical term, no jargon, okay? Now, mortgage insurance is something the banks make you mandatory buy if you have less than 20% down payment. So keep this in mind. A lot of these things, if you have 20% down payment, it does not, I repeat, it does not affect you, okay? So it's probably a good idea if you're gonna buy, have 20% down. But if you don't, banks make you buy the mortgage insurance. What it basically does is, in case you don't pay your mortgage and the technical term is default, then the bank has someone to pay them for the mortgage that they've sent out to you. Here's the ironic part. The bank makes you buy the mortgage insurance, but guess who pays the bank if you default? The Canadian government. It doesn't make sense. The bank makes their money anyways. Either way, that's a topic for another day, but that's probably why mortgages are the bread and butter for the banks, okay? So now that you understand that, the financial stress test, what does that mean, okay? The financial stress test, when you go apply for a mortgage, traditionally you see on the subway or some advertisements, maybe from one of the banks, it says anywhere between 1.99% to 2.5% as of time of shooting, okay? Which is really, 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 really low. The cost to borrow money is so low. It's at an all-time low right now, okay? And we also have, on the flip side of it, what we call the Bank of Canada rate, which right now at the time of shooting is 4.65. It's practically double the rate of the mortgages, okay? So that's the traditional lending rate. Now, why this is important is when you go apply for your mortgage, do your mortgage consultant, what they will do is, again, if you have under 20% down payment, they will test and stress test you against the Bank of Canada rate. So instead of getting that 2.5% rate or 2% rate, you are tested against a 4.65% rate. What does that mean? You effectively can borrow less money. So here's an example on the screen, okay? If you are making $70,000, credit score 680, 5% down. Pre-stress test, you could borrow $500,000. That's a lot of money, okay? Including your down payment, that's probably a 2-bedroom condo in Toronto. Now, post-stress test, you can only borrow $415,000. That's almost 20% less. 20% less because of the stress test. So what is that going to mean ultimately for you? You can borrow less money to buy a condo. And what that does, it may price you out of places, okay? So the moral of the story here is have 20% down payment, okay? We'll be talking in future videos how you can save that 20% down, but if you really, really are going to invest, especially if you're a first-time home buyer, really considering finding a way to get that 20% because you know what? You can't borrow as much money, you'll be stretched thinner, and it's just going to hurt. But there's a silver lining in all of this, okay? If you do go get the mortgage under the stress test and you qualify, you don't pay the 4.65%, you pay the 2.5%. The 4.65% is just in case the interest rates go up because that's what the government is worried about, okay? Now, all of this is great. You understand how it works. What does that mean to your real estate market or property and investment, okay? Again, I can't predict the future, but in my professional opinion, I can see something like this. The first-time home buyers, they are priced out. They are just priced out because they don't have that down payment. So what does that mean? There's going to be more renters. The Canadian government, by implementing the stress test, effectively just made thousands and thousands of more renters. So what does that mean? Likely an increase in demand for rentals and probably need more, it will probably have more increases in prices for rentals. And given the summer that just passed in the September market for rentals, it was already kind of crazy. I saw bidding wars for rentals. So if you own a property right now in the downtown core and looking for rental market, you know what? You could be in luck. You probably could be seeing some positive increase in terms of cash flow from rental. So you are in luck. If you learned something from this video and you enjoyed watching it, make sure you press like down here and subscribe to Prime Properties TO. If you have any questions or any concerns, you can put them in the comment section and our team will do our best to answer them for you. And remember, make sure you share this with your family and friends because an educated consumer is the best consumer. I'll see you next time, Toronto.